Hi, it's Eric Aasness with Homebridge Financial and ericismybanker.com with my weekly update for the week ending October 15th, 2021. No, mortgage rates are not sharply higher this week. That's what several financial headlines shouted this week. And actually, we had a fairly decent week in the mortgage markets. The bond market's been reasonably positive the last few days, and that's helped keep mortgage rates in check. True, though, this week we did have admissions from both the Federal Reserve and also the administration that our inflation is more than just their term transitory. We can expect it to linger well into next year. September's producer price index came out this week. It was up 0.5% for the month and over 8.6% year over year. PPI is what's called a leading economic indicator, and it really reflects the costs that manufacturers are paying to produce their goods. There's a very high likelihood that their higher costs will be passed right along to the consumer. Kind of along that same line, the Cass Freight Index is one statistic I really like to follow. For the month of September, it was up 31% actually year over year, whopping 31%. And that's another cost that absolutely will get passed on to us as consumers. All of that said, the mortgage rates for this week were fairly flat. Here we are, the national average for 30-year fixed rate conventional mortgage, 3.14%, up just slightly from 3.13% last year. 15-year fixed rates, conventional 2.52%, up a little bit from 2.50 last week. FHA and VA rates 2.77% compared to 2.75% last week. And jumbo loans are actually slightly lower, 3.10% compared to 3.11. So all in all, rates are still hanging in there. You know, the week could have gone a lot worse than it did. So we're very thankful for that. While I'm talking about rates, if you purchased your home, the last 1, 2, 3 years, and you had PMI on your loan, we should talk. With the growth in values in homes, you most likely have enough equity to possibly refinance and get rid of that PMI. And there's different ways to get rid of PMI. One way is to pay your existing balance down to 80% of your original purchase price on a conventional loan. You can get rid of it. Another way is if you make substantial improvements to your home, we can do a new appraisal, and as long as your loan amount is no more than 75% of the value of the appraisal, we can get rid of it. Or you can wait 2 years if you haven't done any remodeling, do a new appraisal. And if the loan is no more than 75% of the appraisal, we can get rid of it. But the quicker way also be to look at refinancing. And even if the interest rate on a refinance is the same or even possibly slightly higher than your existing rate, just the fact of removing PMI can significantly lower your monthly payment. I had one client recently we're actually in the process right now. She bought her home 2 years ago with a zero down program, which do carry a higher interest rate. Right now, we're able to refinance her, give her extra cash back to pay off some debts, and her payments ending up lower than where she started. It's not the case for everybody, but it's certainly something where we could definitely run the numbers. If you fall into that category, just message me, give me a call, 206-915-3742, or you can email me, eric@ericismybanker.com, and we can run the numbers. Hope you all have a great weekend. Talk to you soon.